All right, we are wrapping up the backpack program because we got to go buy them all this week and get everything set up. Last year we had provided 30 backpacks at a cost of $250 to individuals who otherwise wouldn't have had anything. $7,500 we spent last year. Our target this year was a minimum of 40 at $300 per backpack, or 12,000, so that's 4,500. And I said for the 4 weeks from the 17th to the 7th, every time you click like, I would add $1. Every time you subscribed during watching these videos, I'd add $1. And all revenue that these videos generated, I would donate as well. And here is what each of them generated in terms of likes plus subscribers plus all revenue. 57.38. The target was 4,500. It's 1,238.40 more, divided by 300 per backpack. That means we can go to 44 backpacks this year. Excellent. I'll be doing this again next summer. Next summer we'll try to raise that target even more, so hopefully I'll have a bigger audience and we'll get even more likes and even more subscribers next year. Next campaign for donations, and most of what we do has kids in mind, is our Christmas program, where we support families for Christmas that again otherwise wouldn't have it. It's mostly for the kids. Last year I think we did 27 mothers with 47 children. Somewhere just shy of 25,000 we spent, plus another $25,000 donation to Big Brothers Big Sisters that was also supported in part by our hat sales. We'll be doing another round of hat sales at the beginning of December, with all proceeds going to Big Brothers Big Sisters. Not only all proceeds, I match whatever somebody buys a $30 hat, I throw in another $45 and we make a $75 donation. So look for that coming up in December to support Big Brothers Big Sisters and our Christmas shopping program. Let's get right to this week's content. Well, what a week. What a rally. Still continuing. Market is threatening 4,300 on the S&P. In fact, if the market rallies another 2.9% from here, in technical language, we are that would put the S&P in a confirmed bull market, which is 20% off the lows. The Nasdaq is already in a confirmed new bull market, and the S&P is 3% from being in a confirmed new bull market, all based on, it seems to me, 1 month's data on CPI and PPI, and that's it. Job done. Everything's okay. Let's go back to the way it was. So that's going to be the tone of this week's market outlook, is we're going to look at the possibility that is true. We'll look at a number of scenarios. We'll do a thought experiment. We'll look at 3 different scenarios, and we'll see what the outcome would be for each of those scenarios. Under what conditions would the Fed lower interest rates? Because that's what the market is pricing in. And it seems to me that is what the bond market is suggesting. And the inverted yield curve could possibly mean that the path of short rates is going lower. Not that we're heading into a recession, but just the path of short rates is lower. And there has been some interesting work done on this, looking at the inversion of the yield curve and asking the question, what exactly about an inverted yield curve is predicting a recession? When we use the 2s to the 10s, the argument is that, well, this is capturing 2 things. It could be capturing the path of the short rate and nothing but the path of the short rate, or it could be capturing a recession, thereby leading to short rates dropping. Which one is it? Is it possible that short rates could just drop because of the nature of the economy without causing any kind of recession at all, or any need for a recession? Because if you look back to the mid-1960s, that did happen. You did see that, and you didn't have a recession. So why can't that repeat again? The preponderance of the evidence suggests that the inverted yield curve from the 2 to the 10 is a good predictor of a recession. 8 of the last 7. It inverted 8 times, and out of those 8 times, 7 of them did end in recession. There is another paper, which I'll show you the links for, which says, listen, if you're using the 2s and 10s, you're confounding two things. You're confounding the possibility of recession with the path of the short rate. Why don't we use a different slope? So they'll use the 3-month rate and the 3-month rate 6 quarters ahead. So it's a forward rate. So they go out a year and a half and they look for a treasury that is maturing in 6 quarters. They look for one that's maturing in 7 quarters, and they say, well, what is the implied 3-month forward rate? And they look for the distance, or the spread between the current 3-month and the forward 3-month, and find that it is a better predictor of just the recession. In other words, it has no information about the short rate path. It's just the recession itself, and they find significance in that. So I'll show you that paper. Anyways, let's have a look at what's going on. As far as where we're headed in the market, I think, when you get to extremes, you can line up on one side or another. Too much selling, well, you got to be bullish. Too much buying, well, you got to be bearish. Well, where are we right now? Are we too bullish? Because we've had this incredible rally. Again, NASDAQ is in bull market territory, a new bull market. S&P is 3%, 2.9% below a new bull market. The forward multiple is over 18. Forward earnings have come down yet again, but inflation seems to be gone. So are we, should we be loading up or should we be cautious? And at this point, I have no easy answer for that because I really don't know. So I looked at the week last week and I thought, well, what do I want to do? And I don't know what I want to do. And whenever you don't know what you want to do, you say, well, hands off the keyboard. I'm just going to sit still. I'm in a good spot. I'm not making great money. I'm not losing money. I'm kind of just going sideways right now. But I cannot be a buyer of this market with an inverted yield curve. I can't get bullish with an inverted yield curve. I need to see it upward sloping, and I'd be a confirmed bull buyer if I saw real rates negative. Well, they're not negative, and the Fed speakers are suggesting last week that the last thing they want to see are negative real rates. In fact, they don't want to go back to negative real rates even once this all passes. So our jobs just got harder. Anyways, let's have a look at what happened to rates. It should be no surprise. Money market rates last week, all the way through last week, hit the highest year to date, except for the 1 year. But really, it's 3 basis points. It's not a big deal. Capital market rates pretty much unchanged. The 2s went up 1 basis point. Everything pretty much stayed flat. The 1s went up 1 basis point. So we still have an inverted yield curve on the 2 to the 10. 41 basis points. That is more of an inversion than we had before 2007, 2008. It rivals the inversion we had before the dot-com crash. But the dot-com crash stayed inverted. The yield curve stayed inverted for a long period of time. We're nowhere near that length of time right now, but 38 days. Now, if we go back through yield curve inversions on the 2s to the 10s, the deeper the inversion and the longer the inversion, the higher the probability of a recession and the higher the hit rate. In other words, depth and duration. The deeper it goes and the longer it stays there, the probability of a recession rises to basically 100%, and it has a 100% hit rate. So we do have to watch both the depth and the duration. If we start to see this go from negative 41 to negative 35 to negative 22, we can start to breathe easier. That's when I would say, as that negative inversion starts correcting, I think you'd want to add more long delta to your portfolio. But right now, I don't want to. And if it stays around this level, let's say -35 to -45 for 45 days, 52 days, 59 days, and it just keeps going, that probability increases and increases based on empirical observation now. Let's look at a Fed balance sheet week ending August 11th. It increased by 16 million. That's a rounding error. That's almost nothing. All it means is over the course of the week, nothing matured. There are certain maturity dates throughout the month, and nothing matured. That's all. Fed fund futures for October, the index is sitting at 97.06. So for 75 basis points, the probability is 75.3%. For a 75 basis point move in September versus 86 last week. So the probability for 75 basis points is dropping. It's not off the table. We'll look at 4 different Fed officials and what they said over the course of last week. 75 is still on the table, but it seems consistent across all of them that 50 basis points is their base case. So 50 is pretty much a done deal, it appears. But 75, the probability is dropping. January is 96.48, which if we think about 125 basis point move, there's 91.6% probability of 125 basis points by the end of December versus 94.8 last week. So the 125, the probability is dropping on that because the belief is there'll be a 50 followed by a 25 and a 25, and then that'll be the end of it. And then just 3 months later, they'll start cutting. We're going to look at the scenarios and ask, does it make sense for them to cut? Under what scenario would they be cutting? Also this week, we get the minutes from the last Fed meeting. But given the 3 big data points we had last week on prices, we had inflation headline at 0% month over month. Not core. Core, if you do the math and you do the price indexes, came in at 4%, the 1 month, month over month, 4% annualized on core, which means you had deflationary pressure on the headline part. And we'll look at that report and we'll see the huge big numbers in front of energy, but we'll put it in perspective. We'll look at year over year for energy and we'll still see that it's super elevated year over year. So maybe there's more room for it to come down. PPI dropped, and we'll look at the stages, stage 1 through stage 4 for PPI, and we'll see that they dropped all the way through the supply channel. That is a good sign and a bad sign, and I'll explain the bad sign when we get there. Look at OAS, our credit spreads. This is investment grade here and high yield. Both of them contracted. High yield, another 7.47%. We're well under 500 on high yield, 4.21. And for investment grade, sitting at 1.42. In investment grade, AA is 80 basis points. Triple B is 1.79. That is the top to the bottom of investment grade. Then you go to the top of high yield, 276 basis points. To the stuff you don't want, 975, down from 1226. Also had a contraction, 63 basis point contraction in spreads. Well, that is supportive of prices. As spreads are contracting, it means the yield is contracting. Lower yields are a result of higher prices, or lower yields push prices higher, whichever way you want to run the causal effect. Let's have a look at real yields and some mortgage rates. Okay, let me show you those links to some interesting papers that you can read. I'm not going to go through it because it is rather technical. It really is for those of you who have the interest to know more, which I imagine isn't very many. So I'll just show you where to find it. This link is in the description box from the Federal Reserve Bank of Chicago. Why does the yield curve slope predict recessions? And it, as it's going through this, it cites a paper by Engstrom and Sharp. They study an alternative yield curve slope measure given by the difference between the 6-quarter ahead forward rate on the U.S. Treasury securities, that is a 3-month rate 6 quarters ahead, versus the current 3-month T-bill, which they call the near-term forward spread. They argue that the 6-quarter head forward rate helps identify relevant market expectations of future monetary policy actions more precisely than spreads based on the 10-year yield. They find that near-term forward spread crowds out other slope measures and probit models predictive of U.S. recessions, and conclude that a negative near-term spread may only predict recessions because it reflects the market's expectations that a contracting economy will induce the Federal Reserve to lower its policy rate. So it isolates just that idea, not just, well, the path of short rates will go down and we'll be okay. It just deals with recession. And if you go to the references at the bottom, here is the reference that you would want, and it's a link. You just click on Crossref and you'll get it. And the paper is right here. You click on original paper and there you have it. It is technical. It is more for a technical reader than not, but it is super interesting. So I'll leave that to you. You don't need the link to this one, because if you have the link to the paper, you just go down to the references, go to reference 5. There is a link there to this paper, and then you can link right to the PDF. So not a lot of information in the real yields and the break-evens. We're seeing the real yields are all still positive from the 5s to the 30s. A little bit of jiggling around for the week, but I would call that basically unchanged. Nothing exciting to see there. Nothing exciting to see here either in the break-even rates, relatively unchanged from the week before. This is really a focus of this FOMC panel or committee. I don't want to say FOMC committee because C is committee. I'm saying the Federal Market Committee. So I'll call it a panel. That they are really focused on keeping real rates positive and real rates at a shorter end as well. We only drop down to the 5-year. This is all I get out of treasury.gov, but we can easily take the 2-year and look at the forward expectation for inflation and calculate what a real yield is there, and they're still negative. So the real yield on the 2-year, the 3-year, I believe the 3-year, where's the 3-year sitting right now? 318. Yeah, so the real yield, we don't have a break-even rate. We could just calculate a real yield on it. They're still negative. They're adamant about getting those positive. Well, you get those positive in one of two ways. You either get the forward, the month-over-month forward inflation rate annualized, you get that lower, or you raise rates at the short end so the money market rates continue to rise. Let's look at mortgage rates. Last week we had 5.45 on a 30-year fix. That's without FHA support. The high was 6.11. We're at 5.33. So mortgage rates are dropping. Earlier in the week, and this is elevated for the week, earlier in the week I saw a 5.08. Closed out last Monday at a 5.08. And I thought, I can't believe this. We're about to go under 5% on the 30-year mortgage in a tightening cycle. Whatever happened to don't fight the Fed? That was the saying for the longest time. Don't fight the Fed. Don't fight the Fed. But now it seems like the market is saying to the Fed, I'll see you outside, buddy boy. You think you're a tough guy? Meet me in the parking lot. They're openly calling the Fed out. And the Fed last week, we had 4 statements last week, which are counter to what the market is doing, saying, you guys are out of your mind if you think that's what we're doing. And the market is openly fighting the Fed, calling them out, calling them names, calling them spineless and weak, and you're going to pivot. You just don't know it, buddy boy, but you're going to pivot. Whatever happened to don't fight the Fed? That's, I guess, that only works when the Fed has your back. But if the Fed doesn't have your back, it's, put them up. Anyways, a 5.33, a 4.72 on FHA last week was 4.96. And I said that this would be supportive for mortgage applications, and squeaked another gain up 0.2. Refis up 3.5. This will be supportive for the refi market. Purchase is down 1.44 because if you see house prices coming down, and you read reports that, well, rates are going to rise a little bit more, so the housing market's going to drop a bit more. For such a big purchase, you are willing to wait a couple more months. So you will push buyers to the sidelines in the housing market, so that wouldn't be unsurprising that you had a drop of 1.44 here, but your refi market is coming back. And let's have a look at our prices. This is for the week ending August 6th. Pretty much unchanged for the same week year over year in terms of median listing prices. Still elevated, up 15.5% over last year. But look, if this goes sideways, that is 0% price in time. That'll be 0% price increase in time. But if it continues, if we look at last year and say, well, from July to August, the price did this, and this year the price did this, well, that is still the same 15.5%. So without looking at a historical chart, we can't really tell too much. We're going to look at the July report, and we're going to see what the trend looks like in prices there. New listings down 8%, down 8%. That's pretty much unchanged. Active listings have dropped from 30% down to 28%, but we are getting into the end of the summer. This is typical. It's seasonal. You active listings from about June onward start to drop. And as you get into the summer, houses that haven't sold usually cut their prices to see if they can get it gone before the end of the summer. So it's typical to see a whole bunch of listing prices being cut too going into the end of the summer. So this is nothing to get excited about. 3 days slower now. Houses are taking longer to sell. Earlier when we started looking at these trends, we were 9 days faster year over year. Then it went to 8, then 6, then 5, 4, 3, 2, 0. Then 1 day slower. Now it's 3 days slower. So the housing market is moving slower. But prices are elevated, but there doesn't seem to be upward price pressure anymore. So that might, in time, work on the sticky component of CPI in the shelter category for rents and for owner's equivalent rent. Now, while we have this going on unchanged, you do not have that going on with rents. Rents are going up. I think a big part of it is being the professionalization of the investor class of the real estate market. The number of houses being sold as second houses, meaning if you own a home and you're buying a second home, that's considered an investor purchase. So an institution that comes in and they're on their 4,000th home, that would be considered part of that group of second homes. The majority of this category of second homes is large institutional buyers. Well, they are cash flow driven, which means they will raise rents to what the market can sustain. It's not your local landlord that you've had a relationship for 10 years. They like you. They say, well, you know, our costs are going up and your rent is going up, but certainly not to the extent where it breaks you and you have to move and they got to put somebody else in. They really like you. They're going to keep you there. That kind of relationship renting is becoming less and less as more and more money enters into alternative categories like real estate. Since it has now been professionalized to such a degree, it is really cash flow managed, and rents, especially in a tight real estate market. And when I say tight, I mean low inventory. Rents have no reason to stop going up. So I think that's a little bit stickier than the Fed would like to see. Let's look at the July report. Okay, this is Realtor.com. Pretty much every house that's listed goes on Realtor.com. If you're listing through an agent, when I say pretty much every house, it's every house through an agent goes on Realtor.com. It is the mall. It is the A mall. If you're listing your house, you want to be on Realtor.com. There's still the FSBO market, FSBO, which is for sale by owner. That Realtor.com says, well, if you're not going to treat any of our agents well, you have no business being here. So it's a small part. Usually FSBO is about 5% of the real estate market. They usually are priced above the market, unrealistic pricing for sale by owner, because they don't have the input of the real estate agent who then gives them a report saying, look at the houses that sold in your neighborhood. You're not going to get that price. Look at your comparables that you're up against. So we can ignore that group. It's a small group and it tends to be a bias group. Active listing count heading in the right direction and with slope, significant slope. So as this continues on, just to put it into context, this green line is 2021. This lighter green line up here is 2020. Here is pre-pandemic levels. We're at 747 for active listing count. This was the inventory levels up here, 1.2, 1.3, 1.4, and for July you can see it should be in the 1.3 to 1.4 million range pre-pandemic. Post-pandemic, yes, the slope is higher. It's heading in the right direction, but still, to put it in an absolute term, 747 versus 1.4, you're down some 45, 50% from pre-pandemic levels on active listings. Total listing count up 3.5 over 2021, but still a long way to go. This is 1.3 million. Pre-pandemic, you were sitting around 1.8 million for total listing count. Pending listing count. This is a listing that is in some stage of completion. In other words, an offer has been accepted, but it's not a done deal yet. It's still going through the process of home inspection, financing conditions, closing. You can all agree on everything, say we'll close in 60 days. In 60 days, it doesn't close. So it's just pending. It is dropping. But if you look at pre-pandemic, they do tend to drop off. This is seasonal. It tends to increase because market activity tends to increase. And then once you get into the summer, it tends to slow down and it drops all the way in to January, with January being the low, and then it recycles again. It's dipping earlier than the other trends. So that would sort of validate what we're seeing in the mortgage applications for new purchases, that there are fewer homes in the pending stage, down 19.4 year over year from 2021. It's even below 2020, but still more activity than we had pre-pandemic. Newly listed homes, there we are right there. You can see the slope is really dropping, but look at all the trends. It is a hump. It peaks April, May, and then it starts to fall off. That once you get into July, August, September, it just drops off down into the end of the year for newly listed. Days on the market. Yes, they are slowing down, but still, look at the difference. Pre-pandemic, a house stayed on the market in this range here, 60 to 65 days. This is 35 days. So it's still a very tight housing market. Houses are selling 30 days faster post-pandemic than pre-pandemic, even though they are slowing down. And here's your listing prices. Look how much higher we are versus, there's 2017, 2018, 2019, 20, 21, every year up, 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 up. In fact, they don't cross each other at any point in time. There's been no point where, in this month, prices were lower year over year. They were consistently higher all the way through year over year. For 2020, why did it get so close over here? Remember, this was the pandemic, right? Everything shut down. You had this nice rise, and then you sort of went sideways. And then it really took off year after year. Look at the difference between what it was just year over year, right? Up 16.6%. This is slow. When you look at it on a national basis, some regions may drop a lot, other regions may hold their value, but on a national basis, it is slow. It's not as if you're going to expect this to just crater and come back down to this 260 level from 449. These prices, those prices are gone. Until inventory far exceeds the demand, these prices are here to stay. We're going sideways for now. But if rates start to drop, though, that trend is going to go right back up again, creating the very shelter inflation which we're trying to avoid because it's a sticky component. It's 32% of CPI. You need this to go sideways for at least a year so that the year-over-year comps on shelter are zero. Right now, I think they're 5.5 to 6.5% year over year. and that makes up 32% of CPI. So we are going sideways. You would need that to go sideways for at least a year so that the year over years becomes zero. I think that's the best you can hope for. You might get some price moderation, especially if you have a very bad recession. Yeah, housing may come down 5, 6, 7% nationally, but it's doubtful that you're going to see a return to the prices that you saw in pre-pandemic, even 2019. Let's look at where we are here, 449. Look at where it was in just 3 years ago, just slightly above 320,000. And you're at 449 right now. So let me just do a quick calculation here. That's 40% in 3 years. That's a ridiculous return, but it is a function of way too much demand all of a sudden. Let's get the hell out of the city, and a lot of remote work. Hey, I don't have to live near where I work. That took supply off the market. Supply was already trending for the last 10 years, was trending below household formation anyways. So you would need a sustained period of overbuilding just to clear that glut. So I don't look for these prices to contract significantly anytime soon. I think the best you can hope for is a sideways movement. Reduced price share, that is significant, right? Some people are starting to realize that, hey, you know what? Those prices I had in my head from January, yeah, those are gone. And if I want to move my house, I'm going to have to drop the price. So it's up 9.7. It is seasonal. Look at each trend, other than the 2020, because of course you had the shutdown, and that's why you had this huge drop down in here, because, well, houses just stopped moving, so you had no activity to measure. But as you go from March to April to May, as you get into the spring and start moving into the summer months, well, you got to move your house, so you start lowering your price. It starts to increase, and then once you get into the fall, it just falls off because you decide, well, I've lowered my price. I'm not going to lower it anymore. I'll just take it off the market. So it is seasonal, but notice the slope of each of them versus this slope. This is significant. One more month, you might actually have the highest amount of decreases, which would make sense if you had 40% price increase over the last 3 years. Come on, right? And if you want to dive into this one a little bit more, you can go into each of the different regions. There's a whole bunch of metro regions listed here as well. Okay, this is a CPI measuring prices for the month of July. Look at that. When this report came out, the futures just jumped and didn't look back until later in the day, and then later in the day seemed to give back everything. And there was a thought, well, if prices are dropping, what's going on with margins? This is the price that consumers are paying. And if this is the price that they're paying and prices are no longer going up, but we know that the employment cost index is going up, what's going on with margins? Maybe we should wait and see the PPI so that we can figure out what's going on with margins. And when they saw the PPI, they said, let's go to the party. Here's headline, all items. You can see the significant drop off. Here is core. That is a sideways movement. This is what the Fed is looking at more than headline. And to be honest, they're not even looking at CPI. They look at PCE. CPI is just a price level indicator. PCE is a cost of living indicator because it measures and weights things based on what consumers actually spend money on, not what prices are. And I've said this before, the price of something can go up significantly. Well, that's an increase in the CPI. But what if nobody buys it at that higher price? Then nobody has experienced that level of inflation. So the PCE measures what people actually buy. What's the price change in the stuff that people actually buy? And their preferred gauge is core PCE. And last month, PCE came in at an annualized rate of over 12%. With CPI down and PPI down, I imagine later this month when we get PCE, it will have to show the same thing. Mathematically, it would have to. Otherwise, there's a big, huge question mark about who's measuring what now, and can we believe any of this stuff anymore? Right? Usually, you put that question mark up when it comes to reports out of China or out of Russia. It's like, well, is that really true? You know, if you get a PCE report that comes in really hot, all of a sudden it's like, well, hang on a second now. Can we even trust the U.S. data anymore? So I expect it to follow suit. Let's see what we have. This is year over year. This last month is year over year. Here's July month over month. Look at these big negative signs. All of them, energy commodities, gasoline, fuel oil, energy services, all of them down. But let's put it in perspective. Year over year, there's your price increase year over year. Still elevated year over year. Two ways to look at that. Well, if it's that elevated year over year, there's a lot more downside that can happen. A lot of that price increase can come out because commodity prices aren't sticky, meaning that you will see deflation in food prices, energy prices, commodity prices. But you don't really see that in rents too much. They're sticky, and you don't see that in wages. You don't see next year, oh, everybody got 6% less. That just doesn't happen. Either they get a normal raise, which is in line with GDP growth, real GDP growth of 2 to 3%, but you don't really see the drop in wages. You may see drop in aggregate incomes as unemployment increases, but that's not what the price level measures. It doesn't measure the aggregate. It measures the price of one unit, one period away. So you could argue, well, there's a lot still that could come out of here. So deflation in these components could lead to negative zero or negative headline, even if some of the components are sticky. Yeah, but the Fed doesn't pay attention to that because they know those flexible prices are super flexible. They know that they are super volatile, so they pull that out to get to the underlying trend. All we should care about is core. And if we look down at some of these other price categories, all items less food and energy, right across here, 5.9%. That is the core, so it's 5.9. That's year over year. That's backwards looking, right? You would have to take this 0.3 and annualize it on a forward basis. And if you look at the differences between the price index month over month, it's 0.334. It's they round it, so it's rounded down to 0.3. But if you annualize that, you get to pretty much 4% on a going forward basis for core. Too high. But again, this is CPI. We're going to have to wait for PCE to get better information, annualize that, and see where that sits. But the Fed has been very clear. Many of the speakers have been very clear. One data point's not going to do it. We need to see it over a sustained period of time. So while this is good, it's promising, it is one step on the pathway that they need. They need many steps down this pathway to see that this is gone, because this is what happened in the 1970s, and we'll take Nixon out of the picture to give you the full idea of what happened there. Nixon went to Arthur Burns and said, "What are you doing with interest rates, man? I need to get reelected. I can get reelected with high inflation, but I cannot get reelected with high unemployment, lower rates." And Burns said, "Yes, sir," and lowered rates. And then after Nixon was gone, and Ford took over, and then you had Carter, and Burns was still there all the way through to the late 70s. If you look at the Fed funds rate decisions, and maybe I'll throw that up. There's an old memo that somebody had retrieved under the Freedom of Information Act that's circulating out there. And it shows the decisions that were made. You see increase, increase, no change, decrease, decrease, increase, increase, decrease, 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 increase, increase over this 3-year period mapped onto CPI. So they were chasing the data instead of saying, well, let's see that it stays on a certain path for a while. They kept chasing it. As soon as they saw it go down, well, okay, let's lower rates. It went back up. Okay, let's raise rates. CPI would then roll over because of the higher rates. Okay, let's lower rates, which would only fuel CPI again. To the end of the decade, where you had 9-10% inflation that could have been avoided the belief is. If Burns had, stayed on a path and said, we need to see that it is gone, not just that it's dropping. So to suddenly change policy, for the market to suddenly say, policy is going to change because of one data point, is the market collectively acting like one of the worst Fed chairs ever, Arthur Burns. And so we'll see if Powell can get a backbone, because he is a reed. He bends in the wind. 2018, he tried raising rates and Trump screamed at him and he said, yes, sir, I'll lower them, just like Nixon yelled at Arthur Burns. So we're still elevated over here. No negative signs down here. This is all items less food and energy year over year. No negative signs, but it's the 1 month over that we want to look for, right? Used cars and trucks, we see are moderating. Apparel, we see is moderating. Transportation services, well, that shouldn't be surprised. If this is dropping, then this should be dropping as well. We can go into the price indexes down here. Let's scroll to the first table. So this is all items. This is food, this is energy, this is all items less food and energy. Here's July and here's June. If you take the percentage difference between these two and then put it to the power of 12, you'll get 4% going forward on an annualized basis for core. Still too high. So that 0.3, it's just rounded off. I wish they would at least go out one more decimal point, because there's a lot of information in that second decimal point. There's a difference between compounding 0.3 for 12 months and compounding 3.45. So one more decimal point, BLS, that wouldn't hurt. But I guess they figure, well, we're giving you 3 decimal points here. What do you want us to do? All your work for you? So you can look at those indexes. Let's look at shelter. Here it is right here. Shelter, rent of primary residence, 0.7. Still elevated, even if you take the 0.7 and annualize that. You're well over 8%. Owner's equivalent rent of residence, 0.6. And we already know that these are sticky. We've already looked in the past at the lag for owner's equivalent rent is about 16 months behind what the price index is. So I would expect that these would stay elevated for a while. If this can go sideways for the next year, it would take a year before those things go to zero. If they can go sideways, that means no more price increases, no decrease, just sideways. That's a lot to ask for, but that's assuming no increases. Well, what do we know about rents? They increase every year. There's always an escalator in rents. They will increase every year unless you have a hollowing out of the rental market where your building is sitting, at 60% occupancy. Well, then you're going to do something with rents. But for that, you need a housing surplus to get done. We don't have that. This goes into a lot more detail. Depending on the types of companies you're invested in and what they make, you can find pretty much every line item in here to determine what is happening to that industry's or that sub-industry's revenues. Because this is measuring if their prices are dropping, well, that's the prices that they're selling stuff at. That means their revenues must be dropping as well. So that was a thought later in the day. Well, hang on a second here. If these prices are dropping, we know that revenues are dropping. Are their costs dropping? We should wait and see the PPI. A lot of information in here. Let's get down to shelter if we can. Let's keep going. Services, shelter. Here we are. So you can see that the increases are still in here. We have a decrease here. This is lodging away from home, hotels. But that's very flexible pricing. Very flexible pricing. Other lodging away from home, including hotels and motels, down 3.2. So that is, again, flexible. There's your 0.6. So if you look over the previous months, 0.6, 0.6, 0.7, 0.6, I don't really see that changing. You look at rent of shelter here, 0.6, 0.6, 0.6. 0.5, okay, a little bit, but this could be 0.612 and this could be 0.598, which means not much. Again, BLS, one extra decimal point would mean a lot. There's another interesting table down here. All items less food, all items less food and shelter. This is an interesting one here. All items less food and shelter, negative 0.6. So you can get an idea that if you looked at all items and you took out food and shelter, all those other items dropped 0.6. Annualize that. That's huge. That is deflation in those particular categories other than food and shelter. So that becomes a bit of an issue. It's like, well, hang on a second. Shouldn't we be worried about too much of that? That'll be one of our scenarios that we look at shortly. And it shows a lot of different categories that you could look at here. Durables, 0.3, which to me is surprising. I would have expected more price give in durables. Non-durables, negative 0.8. And this could just be excessive inventory that's being cleared out. Non-durables, less food, 2.7. Non-durables, less food and beverages, 2.9. So you can really see significant drops in the non-durables, which is in line with what Target and Walmart said. We ordered way too much stuff. We're way oversupplied, and we're going to start cutting prices significantly. Well, I don't think they're the only two that fell into that trap. Let's look at PPI. So a drop in CPI, given where we are, is supportive of equity prices. Hey, the Fed's going to lower rates soon or stop raising rates. But by the end of the day, the thought started to occur to the market that said, well, hang on a second here. CPI is measuring price levels that the final consumer is going to pay. Well, what happens if the costs to the companies are not dropping? That would mean margin compression, which is a bad thing for stocks. Let's wait for PPI. PPI came out, and look at that drop. This is final demand for goods. This here is final demand for services, and notice we're negative when you weight them, negative 0.5. Let's go to the stages of production. Stage 1, 2, 3, 4. Stage 1, intermediate demand. Stage 2, stage 3, stage 4. Because these are the costs that find their way through the system. And 2022, let's look at July. Look at the negatives all across the board. All across the board. This is for prices received. So stage 1 is receiving this much less. Stage 2 is receiving this much less. Stage 3 is receiving this much less. Stage 4 is receiving this much less. And it tells you up here, stage 1 intermediate demand. Tells you a little bit about that. If you want to know more about all of that, you can find that in the technical note. I did take in one, I think it was 2 or 3 weeks ago, I did go through the different stages and the different indexes in the PPI in some detail. So if you remember that, well then this is easy to understand. If not, just go through the technical note. It'll explain exactly what each of the indexes are. But these are all negative across the board. So that means that, well, yeah, the prices being charged to the retailer are dropping, but the prices being paid by the businesses that supply to the retailers, their prices are dropping as well. Oh, margins are going to be okay. Off we go. And these are input costs. Now, within these prices are the labor incurred by stage 1 companies, and in these dropping price as the labor incurred by stage 2. So those prices are dropping. Great. What about the labor cost? ECI does not drop. So the stuff that I buy from you is lower. The stuff that I'm selling is lower in price. However, the labor components are not, which means your margins must be getting constricted because your labor cost didn't drop, but your prices to me dropped. And my prices to the consumer dropped, but my labor prices didn't drop unless I reduce my labor count. That's the only way that I can preserve my margins. So if we think margins are going to be preserved, we would have to expect to see more layoffs. If we don't see unemployment tick up, then as an aggregate, margins would have to decrease because the ECI the last we saw on ECI. The ECI is still elevated. Okay, there is CPI and PPI. Let's look at the Cleveland Fed because they give us a trimmed CPI. The Atlanta Fed gives us trimmed PCE. The Cleveland Fed gives us trimmed PCI. Every Fed does something different. And they also give us median CPI. Let's have a look at those numbers. Okay, so let's look at this chart. We have the median CPI in orange hitting new highs. We have the 16% trimmed mean CPI in blue hitting new highs. CPI in green, well, we did see that pull back in the headline CPI, and core CPI, yeah, that's pulling back as well. So the brown and the green are what we've just seen. The orange and the blue are the median and the trimmed. So the thinking here is, look, there's some volatile components of CPI. So let's just take the 16% trimmed mean. Let's take the top 8% of price changes on the upside and 8% of price changes on the downside, and let's just get rid of those because they're really, really volatile, and let's just look at that middle segment that is more stable. That'll give us a better idea of the underlying trend by getting rid of those super, super flexible components. And up and up and up and up we go. Sorry, the blue line, up and up and up we go. This is a 7% on the trimmed mean. And the median is still sitting over 6%. If we want to look at price change from the previous month, median CPI 0.5, 16% trimmed mean 0.4. CPI was 0, CPI less food and energy was 0.3. We know it's a little more than 0.3. Annualized, it's about 4%. But again, they love just one decimal point. So much information in the second decimal point, people, especially when you're compounding. I shouldn't have to say it, but here I am saying it. But look at the median CPI. Going back to February, 0.5, 0.5, 0.5. May, 0.6, 0.7, right down to 0.5. Something's going on in May and June, which caused it to really jump. So the month over month looks like it's low. But if you skip the May and June and jump back to February, March, April, it's right back on that trend. 16% trend mean, 0.5, 0.5, 0.4. There's the May and June, 0.8, 0.8, and then moderating back to 0.4, which is pretty much where February, March, and April were. CPI, 0. Again, look here, 8, 1.2, 0.3, 1, 1.3, 0. This is really volatile. From 0.8 up to 1.2, down to 0.3, back up to 1, 1.3, down to 0. So I just wouldn't read too much into that because it is so volatile. CPI less food and energy, 5, 3, 6, 6, 7, 3. So we're all the way back to March. These are more stable, which is why they tend to get a little bit more weight because they capture, the belief is they're going to capture that underlying trend in CPI better than the volatile components. If we look at the past 12 months, CPI this is backwards looking, 8.5, less food and energy was 5.9. Median was 6.3, which is above the 5.9, and the 16% trimmed. 8% of the highest gainers and 8% of the highest losers gone, 7%. Look at the trend, 5.7, 6.1, 6.2, 6.5, 6.9, 7. The trimmed mean CPI has not given way. It is continually going higher, albeit it's backwards looking because it's year over year. Well, there's no guarantee that next 12 months are going to look like the last 12 months and you're going to have 7% going forward. But what they're saying is try not to look at the the trend that you think you see here because this is a volatile trend. This is a less volatile trend and more truthful of the underlying trend going on. So if you're trying to judge the current in an ocean, paying attention to the waves and the height of the waves might not tell you anything about the current that is happening under the surface. But again here, 0.4 and 0.5, I think we should take that into consideration because they will. Otherwise, why produce these numbers? And they do look at the trimmed mean PCE, so I don't know why they wouldn't take into account the trimmed mean CPI. I don't see this as lending itself to a 25 basis point move in September. By the way, I heard someone on Bloomberg say, we think the Fed is going to go 25 in September and not 50. Wow. After everything they've said, I mean, saying they're going to go 25 is not only calling them out, but spitting in their face while you're calling them out for a fight. All right, let's see what some of these Fed officials said during the last week. And this was post-CPI. They saw the CPI number, and some of it was after seeing CPI, PPI, and import prices and what they had to say. Thomas Barkin from the Richmond Fed. Let's see if I can find something to write that will write on this. There we go. Nope, still not. There we go, Thomas Barkin. Said Friday, so this was after CPI, this was after PPI, and this was after import prices. All showed that they've moderated significantly. Friday, more interest rate increases will be needed. He said he wants to see inflation running around 2% for a period of time. The current level is far from that goal. Does that guy sound like he's leaning towards 25 basis points? No. This is Mary Daly, San Francisco, Federal Reserve. On Thursday, this is Thursday, so it's after CPI and PPI, but before import prices. 0.5 percentage point interest rate hike in September makes sense. She is open to the possibility of a bigger hike to fight too high inflation. She's saying too high inflation after seeing CPI and after seeing PPI, still referring to it as too high inflation. Does she sound like she's going 25? Her base is 50. I would say his base sounds like 50 as well. I think 50 basis points is the case, but I am open to 75 should the data evolve differently. Daly told Bloomberg TV, saying she does not want to be head faked by the recent improvement in inflation readings, and noting there will be more data on employment and inflation before the Fed's next meeting on September 20th and 21st. That is, the decision comes on the 21st. That is 38 days from now. Here's the thing, for the next 38 days, earnings are pretty much over. And we don't get any more earnings until October. So we can't look for direction from earnings. That's in the rear view mirror now. The next Fed meeting is on the 21st, so we can't really anticipate too much there. All we can do is just read the data that comes out. So right now we are in a market where it's going to trade from economic report to economic report. That's the only thing that matters, is the next economic report, and the next big one we get next week is housing, but the big one we get are Fed minutes on Wednesday at 2. But again, the market's going to say, yeah, but that was in July, way before they saw zero inflation. I don't know that there is much that is going to beat the narrative in the market right now that we are entering a new bull market. The Fed is going to pivot. If they don't know they're going to pivot, we'll teach them a lesson or two. They will pivot when we get through with them, and that's going to be it. And here they all are saying what they're saying. We got two more. Let's look at them. Okay, our next one is Charles Evans. Wednesday's Consumer Price Index report showing U.S. inflation didn't accelerate in July was the first positive reading on price pressures since the Federal Reserve began tightening policy. Chicago Fed President Charles Evans said, even as he signaled he believes the Fed has plenty more work to do. So he's saying, yeah, that's positive, but hang on, we still have plenty more work to do. Not more work. Look at the word, plenty more work to do. With consumer prices unchanged last month compared to June, but up 8.5% from a year earlier, inflation is still unacceptably high, and the Fed will likely need to lift its policy rate, currently in the 2.25 to 2.5% range, to 3.25 to 3.5 this year, and to 3.754 by the end of next year. The market is sort of pricing in 3.5% this year, saying, yeah, that's pretty much where we'll be, but it is not at 4%. In fact, the market is starting to cut as early as the second quarter of 2023, with rate cuts into the end of the year, and he's saying, no, we're not going to turn around. We're probably going to still increase into the end of next year. And we have Neil Kashkari. He's with Minneapolis Fed, the least interesting Fed. So I made his picture smaller to reflect the fact that, well, it's probably the least interesting of them all. And if you look at the picture of his office, he's got a wall behind him that kind of ends, and the window still keeps going, so you can actually talk to somebody on the other side, unless this is the front desk where you walk in, he's sitting there. Can I help you? I don't know. Anyways, he gets a smaller picture. But he's always been more dovish, on the dovish side. What is he saying? Colleague Kashkari is more hawkish, which seems rather, against the grain, expecting the Fed funds rate to rise to nearly 4% by the end of this year. Not 2023, by the end of this year, and almost 4.5% by the close of 2023. Today's data and the strong jobs report from last week didn't change his anticipated rate hike path, he said at the Aspen Ideas Conference on Wednesday. So he saw CPI, but did not see PPI or import prices. As for the U.S. Central Bank trimming rates in early 2023, Kashkari called that idea unrealistic until the Fed is convinced inflation is well on its way back down to the 2% target. This has been consistent with everything we've read in the minutes, everything we saw from the Fed speakers last week. Now that these four have seen some or all of the numbers, are all still saying the same thing. We're not stopping. We're not done. The idea that we're going to pivot is unrealistic. Rates are going to go up into the end of the year, and rates are going to continue to go up in 2023 to the end of that year. So when we look at what the market is doing, and the Fed funds futures is still pricing in rate cuts in the second quarter of 2023. This is openly fighting the Fed. They've come out and said these things, and the market is openly fighting them. Whereas in previous times when the Fed came out and said, we're going to lower rates and we're going to buy a whole bunch of assets, don't fight the Fed, don't fight the Fed, even though the economic data was terrible and you had to hold your nose and just buy the market because you just couldn't buy into it fundamentally. Don't fight the Fed, and you were always right. Don't fight the Fed, don't fight the Fed. Now, fight the freaking Fed. Beat them to a pulp because they're wrong. And they're going to pivot. It just seems to me, I think, I'm not suggesting that the market is going to crash at all with this. All I'm saying with this is that the Fed is saying something. And you've always said don't fight the Fed, but now you're openly fighting the Fed. Shouldn't you have a little bit of caution here? I mean, I'm not saying hit new lows, but when the forward multiple is 18.5 and you're talking about 4,800 or 5,000 price targets by year end in just another 4.5 months, with the Fed saying, you guys have got it all wrong on rates, we're not doing anything that you're saying, wouldn't you have a little trepidation? So I've spent some time thinking about the possible outcomes here because I really want to be bullish, because it's fun being bullish, and that's where you make, the gains are easy to make when the market is going up, and you can make oversized gains if you can believe in the direction. Well, I can't believe in the direction, so it's hard for me to make bets in that direction when I don't believe it. And every day that I see the markets going up and up, I keep thinking, I can't get on board. I want something to work out here. Anyways, so I thought this through. I thought, well, okay, you can have a soft landing, you can have a recession or deflation. So let's think it through and what happens in each one. So for a soft landing, you got to get to target inflation. And the idea of soft landing, right, you still need low unemployment. You need those two things to happen. So to get to target inflation, it can be done in two ways. The sticky components flatline. I don't expect that people are going to take wage cuts. I don't expect that. So the sticky components have to flatline, and if they do, you'll hit your target inflation by August 2023 because you'd need a year to get 0% year over year. So you get to August 23. The flexible components moderate to the target. So you'll get a headline of about 2% inflation as you get closer and closer to August of 2023. There's one way to do it. Another way is the sticky components still flatline, but the flexible components deflate. And if the flexible components deflate, you can get to the target faster than August 2023. However, if the flexible components are deflating, earnings have to come down because the prices that you're selling things for are lower. If the sticky components are flatlining and not dropping, but your prices are dropping, you're going to have some margin compression. Now remember, I'm talking about a soft landing, so I'm saying low inflation. There aren't going to be mass layoffs to preserve margins, which means you're going to have to see earnings drop. Low unemployment, the ECI remains high. That's the employment cost index. And we know the participation rate is under pressure, which means you're still going to have a tight job market if you don't make a dent in unemployment for your soft landing. And if you don't change this, well, that also says earnings must come down. Here's the outcome here. You get a soft landing. Let's say you get your target inflation rate. Inflation is at target. The unemployment is low. Well, there's no need to lower rates. You only lower rates when you want to spur on the economy or you're threatening deflation. But if inflation is not a threat, deflation, I should say, is not a threat, and inflation is at target, well, then your rate might be neutral. You might say, well, we're at a rate where we're neither causing inflation or deflation. We have price stability. We have low unemployment. We have two mandates. Check, check. Let's just stay where we are. So this idea that we're going to get a soft landing and rates are going to come right back down, I think, well, let's say we get the soft landing. Why would rates drop? Why would rates drop if you got those two boxes checked? So if we do get this first scenario, rates aren't going to drop. We're going to 3.5, maybe 4% by 2023, and that's where they'll stay, which means earnings must come down. Why? Because the cost of capital is too high, because the cost of capital is already factoring in rate cuts by the second quarter of next year based on the Fed funds rate. And if there is no reason to lower rates, let's say this goes on for 3 years, well, then you're going to have a 4% Fed funds rate for the next 3 years. Inflation at 2%? Check. Unemployment low? Check. No need to lower rates. Next meeting. Inflation at 2%? Check. Unemployment low? Check. No need to lower rates. And that's exactly what it's going to be, which means the cost of capital is just simply too high right now because it's not factoring in an extended period of that. So for the soft landing, cost of capital is too low, and earnings are going to have to come down, because if your sticky components flatline but the prices you're selling them for drop, because that's how inflation comes down, something has to give. Well, let's say you get a recession. Well, in a recession, there's going to be two possible outcomes. Inflation remains elevated or inflation is at target. If inflation is elevated, the Fed has already said it's willing to accept higher unemployment until inflation is at target. Rates will remain elevated. Maybe they won't maybe they won't rise more, but they're not going to drop, because the Fed might say, listen, inflation is high right now, but unemployment is rising. Let's see if that does some of the work for us, because the best way to cure inflation is a recession. That's the fastest and best way to get it out of the system, is with a recession. We don't need to raise rates, but why would we lower rates when inflation is elevated? You can head into a recession. Inflation is at target. Rates could moderate and QT could pause. I don't see QT resuming, but rates could moderate. So if you believe that, well, the Fed is going to pause and then cut rates, you have to be in the recession camp. You cannot be in the soft landing camp. If you believe that rates are going to come down next year, you cannot be in the soft landing camp. You have to be in the recession camp. Well, what if we get deflation? Well, if you get deflation, rates will drop, QT will pause, maybe even reverse if persistent, because the Fed does not want deflation. Look at what Japan is doing to avoid deflation, and what they've done for the last 22 years to avoid deflation. However, if you are getting deflation, that means prices are dropping. The sticky components will still remain sticky. Wages will still remain sticky. Earnings must drop, and I put 2 arrows now, because in deflation, the price that companies are charging, they have no pricing power anymore. Their prices will drop and drop and drop. If their wages are sticky, all they can do to get the wage component on their income statement down is to reduce headcount. So unemployment would go up. This is not an environment you want. So if you believe that rates are going to drop and we're not going to have a soft landing, you must be thinking that we're getting deflation. If you think our rates are going to drop, you must be in the recession camp. But if you're in the soft landing camp, where's the motivation to drop rates? Inflation is going to come down to 2%. Unemployment is going to remain low. If your job was done, if you looked at it going, I don't have anything to do on price stability, and I have nothing to do on unemployment. I just got through this nasty thing of inflation. I'm not about to lower rates to bring that monster back. You're going to keep rates elevated for an extended period of time. When I do scenarios like this, I then step back and I say, well, what is the same under each scenario? If we get a soft landing, can I be bullish on equities? Not really. Not bearish, but I'm certainly not bullish, because I think that earnings have to come down. There's going to be some margin compression, because remember, with my soft landing, I still have low unemployment. If I do, the ECI is going to remain high. Every company has employment costs. It is not all of their margin, but it's there. All they can do is reduce headcount. But if they reduce headcount, I can't be in the soft landing category. I must be in the recession camp. And if I'm in the recession camp, well, then earnings always come down in recessions. I can't be bullish about equities. And if I'm in neither of those camps saying, well, we're not going to have a recession, rates are going to come down, I have to believe there's a reason for the Fed to lower rates. And it would have to be deflation. If it's not because unemployment is too high, it must be because we have deflation. And if we have deflation, I cannot be bullish on equities. So under all 3 scenarios, I cannot be bullish on equities. Here I would be bearish. Here I would be bearish. Here I would be not bullish. That doesn't mean that I'm bearish. It just means that I just can't get on board this rally. That doesn't mean it can't go any further. Markets have shown themselves to be irrational. Cryptocurrency is a good example of absolute irrationality. That it still exists, that it's still a thing, surprises me, but there it is. So it helps me, when I do this, it helps me think about the outcomes that I would want. Right now, the market is planning for soft landing. Fine, if we get a soft landing, I think things will roll out such that the rate that we see in the market is going to be elevated for longer than what you think, and that is going to weigh on valuations, because cost of capital are going to have to increase into that. Let's look at earnings. All right, well, look at this. We're still heading up Q2 2022. Based on what has been reported so far. These were the expectations, and this is the actuality. We're actually increasing. We can look down here and we can see for the S&P 500, the surprise factor is 6.1%. Energy makes up 11.4% of that surprise. Well, not 11.4% of it, but weighting-wise, you have 11.4% surprise factor on the energy sector. If you take it out, you're still positive. Look at all your numbers: 7, 8, 4, 9, 1, 3, 8, 8, 3, 5, 4, 5, 7, 8, 6, 8, 5, 9. It's not as if any of these are negative, so removing energy is suddenly not going to turn the surprise factor negative. So 6.1. If we look at revenues, up 2.9, above estimates. You can't take that 2.9 and say, oh, but inflation was 8.5. This is 2.9 above the estimate that we had for revenue. It wasn't that it was 2.9% revenue growth. It was 2.9% upside surprise on revenues. If we scroll down here and look at the forward earnings, 232.93, down from 234 and change last week. So it's down like almost 0.5%. Again, dropping. But, you know, if we head back up here to the chart, this was the expectation going into earnings. It was dropping, and then the reality showed up. So yeah, the forward estimate is dropping, but not in such a way that you would say, wow, this is really dropping off, but dropping in a way that you would say, yeah, but it does that all the time. Where are we? It drops all the time. And then you have the surprise factor. So all that forward earnings, you could say, all that is, that 232.93, is lowered expectations, which will then be easier to beat. You could always look at it in that light. This is 18.1, but this is based on Friday opening price on the index. We know Friday had a good day, so we'll look at what the closing price was. We'll look at the index on a closing one on the next screen to see what the multiple is. We have some companies reporting earnings this week, and it's mostly in the consumer staples space. Where are we here? Down here. Tuesday, Walmart, and you also have Home Depot, and you have Lowe's, Target, TJX, you have Bath and Body Works. Keep going here. We have Ross Stores, Applied Materials, Estee Lauder, and Deere going into Friday. So there's still some important companies reporting earnings this week. I think Walmart and Target are going to be important to listen to based on what they said last earnings. And Walmart did come out in between, I think, a couple weeks ago and warned on their margins again. So did they warn enough to lower expectations such that they can beat it and show momentum and show that they're fixing the problem faster? I don't know, but we'll see what Walmart and Target have to say. And if they say things are getting better, well, then this rally does have legs, and you might end next week with that 3% increase in the SPY and get yourself into a confirmed new bull market in the oddest place possible, in a parking lot fight with the Fed. Interesting. Here's a 5-year chart of SPY, the ETF that tracks the S&P 500. As of the closing on Friday on the index, divided by its forward 4-quarter estimate of earnings, 18.37. I've seen estimates range from 18.1 up to 18.7. This one I got from Wall Street Journal as an estimate of the forward multiple. To put it in perspective, let's look at the average, the 5-year average, 10-year, 15, and 20-year average. So the 5-year average is 18.6, and we're sitting at 18.37. The 10-year average, 16.7, that would put the index at 38.89, and the 15-year average, quite stable after that, the 15, same with the 20-year, 36.10. What are these two lines here? This is the top of a channel. This is the bottom of a channel. If you go back to 2009 for the recovery after the crash was over, and you look at the top, a dry top channel and a bottom channel, these are the a resistance line to the upward rising channel, and a support line, I should say, as opposed to the top and bottom. 3920 to 2900 was a fairly wide range, where you have increasing forward multiples, and this would be decreasing forward multiples. And if we think about the center of this particular channel, you get to somewhere around 3400. So the 38.89 is just below the upper resistance line on what was that channel, and 36.10 is somewhere above the midpoint. If we're looking historically, for this last period of time, all the way to about there. Actually, we can go all the way out to about here. You had Fed support because you had low rates for an extended period of time, and you had consistent balance sheet increases. You had QE going on at the same time, along with fiscal deficits every single year, spending for the sake of spending. So that was very supportive. Other thing I should mention as well is you had significantly negative real rates, which is very supportive of equity prices. So we're in this period right now going forward, and during this period of time, we don't have Fed support. The Fed is not behind us. The Fed is now in front of us. So the Fed is a headwind not a tailwind. You have rates that are rising. You have positive real rates, and you have QT, not QE. And you do have, if we look at the last two GDP reports, you do have contraction in government spending, which, heck, we haven't seen since, I can't remember when, but we have contraction in government spending. So there's more headwinds there. I don't know that we can expect that valuations should be at the upper end of the valuation range, given the headwinds that we have. So this rally over here, I'm having a hard time believing that this is anything more than a bear market rally, because it is relying quite heavily on a narrative of the Fed pivot this fall, an end of the tightening cycle, and then a reduction in the Fed rate beginning in Q2 of 2023. And there is not one single Fed individual in the last 2-3 weeks that has said anything remotely near that. Here it's don't fight the Fed. I don't see why that should change going forward. So I'm having a hard time believing this is anything than a bear market rally, especially when you have the 2s to 10s inverted by 41 basis points. And since the inflation report came out, that is unchanged week over week. It has not changed the market's mind on that at all. So this is where I'm, sort of in a holding pattern. I'd like to believe it because there is a certain comfort with being long and strong. I just have this feeling that as soon as I get long, as soon as I commit to all long is right when I should not have done it, and my instincts would have been right to begin with. But you see the market go up and you're more on the sidelines because you've positioned yourself to be delta neutral. And I shouldn't say I'm completely delta neutral. I have long deltas in certain positions that are doing well, and then I have short deltas. Some are going sideways, some are not doing well at all. But at the portfolio level, I'm not really participating in any more upside at this point because I've exhausted my positive delta. My negative delta is now slightly larger than my positive delta just because options are non-linear. So as the market goes up, your positive deltas will not keep pace with the increase in the negative delta. So last week was a big decision. Is after the PPI report, I thought, okay, that is the second. That's the second data point in a row. This narrative is already bulletproof. This is going to make this narrative absolutely bulletproof. That the only thing that can change this is not Fed speak, but the Fed actually doing what it says it's going to do. Now, if the Fed, my thinking was this, if the Fed goes 50 basis points in September, that fuels the narrative that we're going higher because they've backed away from 75. They're at 50. The market is fully pricing in 50 and discounting 75. If they go 50, the market will say, see, told you, they're going to slow down. Then it will be 2 more 25s and we're done. That will just fuel the rally into the end of the year. So I thought, well, look, I don't know what's going to happen, but let me remove this negative delta. And just as I was about to do it, I stopped and I said, no, you know what? Every time I do that, every time I mess around, a couple weeks later, I'm proven right. So I'm just going to sit and wait. That doesn't mean I'm advising anybody to be short the market with a narrative like this going on with nothing. There's no catalysts between now and September 21st other than economic reports coming out. And with the narrative as strong as it is, any little wiggle in any economic report, you can have an economic report come out that says bad, 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 promising, and they'll zoom in on the promising and bring the market higher. At this point, I'm comfortable with it. It's not fun watching, but I'm comfortable in the decision that I've made because looking at it historically, looking at this in context, that you had all of this as a tailwind, and this is the channels that you had, and now you've got this as headwinds, and we're playing up around the higher levels up here. In fact, if I'm going to be really technical, what do we see here? You see a head and shoulders. Here's the neckline. If you draw it down, it kind of looks like that happened. And we're back up to the neckline. That just might be our resistance level. I don't know. With technicals, you can draw almost anything on a chart and see exactly what you want to see, right? Long story short, I'm not going to fight the Fed. I believe what they say. I think it's going to be higher rates for a longer period of time. I think they're going to ignore the flexible component. I think they're going to pay attention to the core component. I think the trimmed PCE and the median PCEs will be overweighted versus just the raw headline and the raw core PCE. I think the labor market is tight and is going to continue to remain tight. And I think inflation, core inflation, even on an annualized basis at 4%, is still double double the target that the Fed wants. And I do think that they have some idea that if they just give the market 50 basis points in September, the market will say, see, the Fed is going to pivot and financial conditions will actually loosen. Because what has happened in the last little while? Since the Fed made their decision and with the data that have come out, financial conditions have loosened. Exactly what the Fed did not want to happen and does not want to happen, it has loosened. That there is a story of 75 basis points in September because the market's expecting 50. And if they give the market 50, they will be seen as being weak and bending to the will of the market. And I think if they want to send a signal that financial conditions have to remain tight because we're dead serious about inflation, 50 would do it, but they'd have to go 75 to push the market back. To say, no, we are not spineless like you think we are. What we say matters. You're fighting us and you're going to lose. Because I think it's a fight now and I think they know it's a fight. So I can see a case for 75. But if they go 50... we could continue this rally into the end of the year. But again, 38 days. That's what you have to understand, is that you have 38 days in front of you for the narrative to continue on. Central bankers have been speaking, but the market has got their fingers in their ears saying, I can't hear you, and I don't believe you anyways. The Fed Funds Futures is making that very clear, that they do not believe a single word the Fed is saying other than, yeah, you'll hit 3.5 by the end of the year, but by second quarter of 2023, you'll be cutting rates. You just don't know it yet. You'll be cutting rates. We've looked at the scenarios under which a rate cut would make any sense whatsoever. So, as far as I'm concerned, at this level, at this multiple, I simply just can't commit to more long delta than I already have. I'm just going to hold the positions that I have. All right, let's look at our week ahead in the economic space. Not a lot that can move markets. Wednesday we have minutes. I think there might be some reflection on that. On Monday, housing market index. We got a lot of housing information this week. Going into Tuesday for Canada, we have our inflation rate. I expect that it would probably follow suit with the U.S. If it doesn't, if it's significantly different than what the U.S. was, well, then that's a big question mark. Is the U.S. experiencing a very particular type of inflation that's particular to its own country? And does its strong dollar have something to do with the results that we saw? I don't know, but we'll see what happens on with the inflation rate here. It should follow suit. Building permits and housing starts on that same day, followed by industrial production at 9:15. Next day, mortgage applications, Wednesday at 7. This will be interesting. The retail sales on Wednesday at 8:30. It's for the month of July, and during the month of July, the CPI data showed us that prices were coming down. So prices were coming down during the month of July. We should see a nice boost to retail sales. It should come in stronger, and if it does, well, there's another boost to the market as well. Fed speak, Bowman. I don't think that, I looked at the calendar on what the topics are. One of them are about COVID-19 and the role of women. Another one was I forget what it was about, but it just didn't seem related to anything about monetary policy. But you never know what they're going to say, right? But she's speaking twice, once in the morning, once in the evening. Business inventories, there's the FOMC minutes right there. That's going to be a big one at 2 o'clock. I think the language will be pretty strong towards inflation, like it has been for the last 3 sets of minutes that we've read, where the language, actually over the last 3, if you go back, the language got progressively more hawkish about inflation. I don't expect that to change, and maybe that might give the market some pause if the market hasn't already paused and retreated a little bit earlier in the week, maybe rethinking the exuberance of where it's going. Continuing jobless claims, that's becoming more important to watch because it has been ticking up and it is a leading indicator. So let's see what direction continuing jobless claims go. What else we got? Leading index. It's been negative for a while. I think the last 3 or the last 4 readings have been negative, and it has been negative whenever it's been negative for that long. It has always ended in recession at some point. So let's see if this turns around. Existing home sales, and then you have more Fed speak here Thursday at 1:20. Canada has retail sales on Friday morning. There's really nothing else going on Friday morning. If my thinking is if the FOMC minutes don't change the narrative or don't make a dent in the narrative, I don't know what data point other than the next employment report that comes out in September. I don't know what data point would change that narrative going forward because you have no other catalysts. It's only the really big reports that are going to matter. Well, we have PCE, I think, at the end of next week. Yeah, so if the FOMC minutes can't do anything to dent anything, we have the PCE at the end of next week. But being that it's going to cover the same period, I don't know that it's going to show anything diametrically opposed to CPI. Usually CPI overstates things. PCE is a little bit more moderate. That if CPI came down that much, PCE will probably be just as supportive. I don't know what could turn this market around other than, all the Fed speakers going on TV all at the same time saying you are all absolutely freaking wrong if you think we're budging. And because of that, we're going to go 100 in September just to make our point. Unless they come out and actually say that, I don't know what's going to dent this market. So before we take off here, I just want to try to put your risk into perspective. Most people, when they're in the market, are buying particular securities. And they could be in any of the sectors. Typically, it is concentrated in technology, typically in small cap. It is extremely overweighted by the retail trader. Or the retail investor. And the younger the retail investor, the younger, I say investor and trader because they do take 2 different perspectives. The younger the financial market participant, the more heavily overweight they are technology names and more in the small cap space. When you take on security risk, there's a belief that you're taking on the risk of that particular security, and within that security there is some market risk. But you're taking on a significant amount of risk, and I don't think most people truly understand the risk they're taking on. Yes, you're exposed to market risk, but depending on what sector you're holding your security in, you're also exposed to sector risk. For example, in a recession, consumer staples does very well, whereas technology does really, really bad. So you do have that sector exposure. Within the sector, you have different industry groups. So for example, consumer staples has 3 industry groups. Well, you have that particular risk as well. You have industry risk because you're within a particular industry in that industry group. You got sub-industry risk, and then you got security risk. So sometimes it might make sense for you to figure out, well, hang on now. Let me look at all the securities that I have and let's figure out exactly what sector I'm in, what industry I'm in, what sub-industry I'm in, you may find out that you have extremely concentrated risk. For you to be right over here, you have to be, the market has to be in your favor, the sector has to be in your favor, same with the industry, the sub-industry, and the security. And here's why. You can buy the security, or you can just buy an ETF that tracks the market. So you have to believe that the security is going to outperform the market. Well, what if it doesn't? The idea of, I'm going to buy this because I think it's going up. Listen, in a bull market, 90% of stocks go up. But will they go up by more than the market? That's the game that you're playing. You want to, because if it doesn't, if over the past week you look at your portfolio performance and you look at how the market performed and the market beat you, you would have been a lot better off simply owning the market. So you do have to benchmark yourself against something. The market could go up, but you could just be in the wrong sector. In a strong market, consumer staples will underperform. So if we look at a chart at 0 here and the market's going up, consumer staples will still go up, but it'll underperform. Information technology tends to outperform, along with consumer discretionary tends to outperform as well. Energy, well, shows no relationship. Same with healthcare. Who knows? It requires a lot of different forecasting for that as well. So if we thought that we were going to be in a strong market and you're buying particular names, are those names in consumer discretionary or technology? Because if they are, you're in the right sector. Then it makes sense to say, I should have sector exposure instead of market exposure because the sector will do better than the market. So you move to the next ring of risk. And now you're in here, as opposed to way out here at a high level of risk. Well, that sector has different industry groups. And you might look at those industry groups and say, well, I think that this industry group will outperform. Because if you don't know which industry group is going to outperform, how do you know which stock is going to outperform the sector? Sometimes it might be good enough just to stay in the particular sector, have sector exposure and say, I'm not going to be a stock picker. I'm just going to have sector exposure. But in that sector, you might say, no, this particular industry group will do better. But in that industry group, I don't know which industry will do better. Well, then that's as far as you should go in that particular sector. Maybe in consumer staples, you say, well, I think if you were looking at planning for a recession, you think, well, I think consumer staples is going to outperform over the next 3 or 4 quarters. I like this particular industry group, this industry, but as far as sub-industries, I don't know. Well, then this is where you invest. You move out of your core to the level of risk in which you have some opinion. But if you have no opinion past that, then you don't go past that. So a lot of concentration is here. Retail traders really load up on technology names. Well, how do you know that this sector is going to be in favor? And of this sector, how do you know which industry will perform better than the sector? How do you know which sub-industry will perform better than the industry? And how do you know which stock will perform better than the peers in that sub-industry? If you don't know the answer to that, if you can't figure out the answers here, you should be in this part of the ring. And if you don't know the answer here, then you should back up and be in this part of the ring. And if you don't have any information here, you get what I'm saying. This is your home base. Everybody that I know, I shouldn't say everybody that I know, but everybody that I've seen enters the market here. And that's the wrong place to enter the market. Enter the market here, and then you work your way out. You work your way out by saying, what phase of the business cycle are we in? Every phase favors particular sectors. From there, you can say, look, I'll get the market return, but can I do better than the market return? I know I can sector time. I can say, I'm clearly in this stage of the business cycle. This is the sector I should be in. Then you step out and you add a little bit of risk. Then in this sector, you look at the broad industry groups and you say, okay, well, I'm in consumer durables, let's say. I don't want to be in automotive and I don't want to be in home building. I like this other group. I think the other industry group will outperform. So you'll move into that industry group. And then you can move that way. From that industry group, there might be a particular industry where you say that will outperform the group. This sub-industry will outperform, and in this sub-industry with these 4 stocks, I'll pick that one. You work your way from the market to the security, at each time asking the question, if I'm in the market, is there a sector that will outperform? And if you get a clear answer, if you feel yes there is, you move to that sector. In that sector, you say, is there an industry group that is expected to outperform? And if you feel you have an answer, you move to that industry group. From there, you look at the industries in that industry group and you say, is there an industry that's expected to outperform? And if you don't have an answer, there's the end. That's as far as you go, which means you're taking on just the risk that you are aware of. This is the problem with a lot of retail investing versus institutional investing. Institutional investing will start with the market and then look for outperformers. Even if you're a stock picker, a bottom-up stock picker, you're still going to try to find the sectors that you think are going to do well. You're still going to place it in context of the market. Retail traders tend to enter the, we'll call them rings of risk. They tend to enter at the highest ring of risk. And you should be entering at the lowest ring of risk and working your way out to a point where you say, I don't know anything more about anything. So here's a good example. I can have market exposure. I buy the SPY. I have exposure to 11 sectors. So I have some exposure to everything, including healthcare. I ask myself, am I in a phase of the cycle where I expect healthcare to outperform? Since I know very little about healthcare, I can block that off right there. That's it. My exposure to healthcare is equal weight the market. Since I own the market, since I'm long the market, I'm long healthcare, but I see no reason to be overweight or underweight because I have no idea. I have no opinion. For consumer discretionary, for technology, they tend to do very well at the beginning of a cycle. Staples does very well at the top of a cycle and into a contraction. Energy has its own dynamics, and you have to be aware of what's going on in the energy market. Materials has its phase of the business cycle that it's like. Real estate has its particular drivers, and there are times where real estate is in favor. So starting from the middle and working your way out is a better way to add risk to your portfolio than starting from the outside and working your way in. For the Applied Series course, if you are a subscriber, the first sector is consumer discretionary. Consumer discretionary, that will be up sometime late Monday, maybe early Tuesday. The video is done. It's just the edits and the rendering. You got to put it in Final Cut Pro. You got to do your edits. You got to export it. You got to upload it to Amazon. It then renders in a whole bunch of. It's all just time at this point of how long all of that stuff takes. But it's done. Consumer discretionary will be up on Monday, hopefully Monday evening, and then roughly about every 10 days, a new sector will be up as well.